Good afternoon, this is Steve Dalton from AgVantage Commodities. I wanted to start by giving a recap on last week's USDA WASDE report, as well as talk about some local pricing here in northern New South Wales, southern Queensland. In my report on the weekend, I said that the USDA WASDE report would be our next major influence on grain prices. Soybeans, corn, cotton were higher, and we saw wheat slightly lower. Why? Well, the WASDE report lowered US ending stocks for soybeans, corn, wheat and cotton. However, they did raise global stocks of wheat. The report was certainly bullish for soybeans and corn, and we saw those rally nicely. We saw a bit of a sell-off overnight, but that's not unusual in markets that have rallied strongly. Often they'll check themselves and then look for further direction. Essentially though, nothing's really changed. So we really need to look at what else is happening that might indicate where these markets are headed next. The report explained the dynamics behind the recent rally in commodity prices or ag commodity prices. It touched on why they're so complex and markets are complex. You know, they have a lot of idiosyncrasies, they have a lot of correlations that if one thing changes, it can have a flow-on effect. Information and circumstances can change very quickly these days. So whilst you might have a firm view today, that could change in 5 minutes, let alone in 5 days or 5 months. So the dynamics basically reflect a rebound in China purchases of US soybeans. And that's largely due to the recovery of the Chinese pork industry due to its decline on the back of African swine fever. So as they recover from that, as they recover from COVID, they're starting to build their hog numbers up, which is creating more demand for feed rations, which is creating more demand for the likes of soybeans and corn. Also, the recent rally is as a result of limited availability of exportable supplies out of South America due to low, or record low really, exchange rates over there for the Argentinian farmer or South American producers. So that's made their sell prices very attractive and makes the purchase price for the likes of Brazil, which has bought a lot of that stock, attractive on the buy side. So it's a recipe for strong selling, strong buying. So as soybean stocks have been drawn down, this has resulted in China aggressively saying, well, hey, we better secure some stock here so we have enough for our own internal supplies. So that's why we've seen the major rally. Chinese demand, depleting stocks, and the reasons for that. Total outstanding sales for all markets through mid-September, including all unknown destinations that will eventually be disclosed to the USDA, that was at a record 32 million tonnes. And that's a threefold increase compared to 2019. So you can imagine, thinking about that on practical terms, these shippers have a hell of a lot of soybeans to ship, and therefore capacity is going to be constrained, and shipping capacity costs probably go up. So, they've got a big job ahead of them. And touching on wheat, as I said, wheat was off slightly on Friday. It's since recovered slightly and it's back trading through $6. Currently, if I look, December wheat Chicago is trading at 601 3/4 US cents a bushel. So that's up about 6 cents from where it declined after the report. I think it got down to about a 5.94. So it's currently up through $6, which is an important target or psychological level. It'll be key now to watch to see whether we can see it trade and stay above that $6 mark. I think wheat didn't rally, and it's been steady on the back of USDA raising global stocks, as I said earlier, and the underlying support for wheat is not so pronounced, whilst all eyes seem to be on the main game, which is corn and soybeans. As many of you would know, corn, if we think of it as a train, corn's the engine of the train, of the grain train. So, corn is really the dog, and then soybeans, and then wheat's really the tail. So when there's something happening in corn and soybeans, generally it will have some effect on wheat. And we've seen that in the recent WASDE report, which is further supported by the decreased supply of corn. We've spoken about soybeans, now corn out of Europe, and weather concerns in South America. Whilst corn supplies and forecast ending stocks are reasonable, soybeans are flying out the door. That's the reality. So this could result in a gravitational pull on corn and then wheat. So as soybeans and corn supplies are drawn down, wheat will be required to fill those gaps for stock feed. So whilst all eyes seem to be on corn and beans, wheat does, in my opinion, have an opportunity to be pulled along for the ride. And at the end of the day, we don't really care why, we just want prices to be higher if you're a local Australian seller. The other point to keep in mind is that supply and demand numbers are often looked at from a 12-month perspective. So they're looked at, they're analysed, they're forecast, but in reality, and practically, they're dealt with over a 6-month or a shipping basis, a shipping period. And currently in the US, their export ports are running at capacity. So, the people that have a view of declining or significantly declining prices, the bears out there, and if the market's going down, the market's going down. If the market's going up, the market's going up. You've just got to call it how you see. And I think the bears out there suggesting that Australia is going to have plenty of wheat and that the US and Canada can fill any price gaps if Australian wheat gets too expensive is not entirely true. The reality is it could well turn out that the Black Sea regions focus or are incentivised on supplying deficit regions in the Northern Hemisphere and may not have the incentive necessarily to supply Australia's backyard, that is Asia. So ideally that creates a scenario where Australia has a very large demand pool in Asia, pulling on our wheat supply, which hopefully helps our price. The other thing is the ongoing concerns about excessively dry planting conditions in the Black Sea. They haven't gone away, they still remain. But obviously we do need to keep in mind any supply impact out of the Black Sea region is probably not so applicable until 2021, next year. So in summary, the primary themes in the market are the persistent Chinese demand, US dollar weakness, which makes US exports, US commodity exports cheaper for the purchaser, and potentially even tighter carry out in soybeans than what's currently forecast. The carry out in soybeans really will be a function of the size of the Brazilian new crop, so we need to keep an eye on that. And in the case of a Brazilian crop production downgrade, I would bet that prices would trade significantly higher from current levels. So soybean stocks are tight. If they get tighter through a downgrade in South America, we'll see prices firm. There's just no room in the balance sheet for an adverse crop event, given the current world S&D. So the correlation between corn, soybeans and wheat continues to be high. So the interesting correlation to keep an eye on is the decline or rise in the price of soybeans, corn and wheat coincide with the rally and decline of the US index, US dollar index. So you might be saying, what the hell does that have to do with grains? Well, the answer to that is managed money and inflation. Separately, we'll put them together. Managed money, you've got investment funds, superannuation funds, looking to park money. Obviously, in the current environment with COVID, you have concerns about where to invest money. And if we see the US dollar index go down, that could be a sign of, it could be seen as a sign of inflation, and you might see managed money move to commodities to look at managing that inflation risk. So managed money is going into purchasing commodities, especially soybeans. And in soybeans, that long position is approaching the largest long in 5 years. Now here lies the danger. You know, a market structure such as this one is highly susceptible to price changes. And we should never forget the saying, markets go up using the stairs and come down using the elevator. Never forget that. You know, prices rise and rise, but they don't have to keep doing it forever. So even though fundamentally soybeans remain bullish, managed money funds continue to add length in corn. So the longer they get in soybeans, the longer they get in corn, at some point, they've got to hit the exit door. It's a bit like a game of poker. You're only willing to bet so much before you decide, you know, you've got to cash in your chips and go home. Therefore, we could see some increased price movements on that. And I think as the market rallies and as we become closer to our production security, we should be looking to sell into this rally. Having said that, I think there's some rewards for people that store wheat into next year, providing, you know, from what I've discussed today continues to happen. But, you know, it's one of those things, you can't have a view for 6 months' time and not revise it on a regular basis because things change. You know, we haven't grown a summer crop here in many years. We have to get through that yet. We haven't had the Northern Hemisphere winter crop that's being planted in the coming months harvested yet. So we don't know how it's all going to pan out. So the next thing I thought I would touch on is some local cash prices. Currently, if we're looking at an NTP, a nearest terminal port, we're seeing central Queensland wheat in the mid 315s to 320, depending on the site. Brisbane's being bid around about a 316. This is for APW, and Newcastle up nicely today at a 324. I spoke last week on the disappointing barley performance, and you know, nothing's really changed there. And we're seeing barley numbers around a Brisbane track level at the mid 250s, sort of 256.5, with barley at Newcastle more around sort of 240, 245. Canola is being bid around 600 track, and chickpeas 651 Brisbane, 660 Newcastle. We look at sorghum at a 337 track Brisbane, a 325 Newcastle. Cotton, we're seeing bids on 2021 at 525, 2022 at 515, and 23 around 490. Delivered Narrabri chickpeas, we are looking at a 630, and faba beans are an interesting one. I think we're going to see some washout support for faba beans initially, then I think we'll see that market decline as we see sellers take that sort of 400 delivered local packet price. You know, traditionally we see when the export market's in control of the faba bean market, traditionally we see our best prices in northern New South Wales in October, before southern New South Wales, Victoria and South Australian beans come online. They're going to have a reasonable harvest down there this year from all reports, so that I would expect to see pressure come on the faba bean market once their harvest continues. And remember, once their harvest continues, the Middle East does prefer those southern beans, that Fiesta variety type bean over northern New South Wales. It's one of the only commodities where they have it over us in that department. So chickpeas, obviously there's a bit of rumour around chickpeas at the moment that the Indian government might come in and reduce the import tariff they've imposed on Australian chickpeas. That has assisted a rally in the market over the last month of around $150 a tonne. Now, there doesn't appear to be any substance to those rumours at this point in time, and therefore, it's very hard to say which way this chickpea market's going to go. Trying to predict what the Indian government's going to do also is near impossible. So once people are comfortable with their chickpea production and quality, I think you would be looking to sell into this market. And certainly that would be for faba beans as well. And there is a big disparity between Queensland wheat and Newcastle or New South Wales. I'll probably rephrase that. There's a big difference between Brisbane market wheat on protein and Newcastle wheat on protein. Newcastle paying greater premiums for protein over Queensland at Brisbane zone. So people up around that border region, it would be worthwhile looking at the numbers and looking at the spreads once you know your quality, whether the protein market is going to be best for you or whether the feed market is going to be best. As you move further south, that'll become less applicable. I'll wrap it up there. In the meantime, please feel free to contact me on 02 6792 2962 if I can help out with any information, answer any questions, and certainly follow up on market's best pricing for you. Thank you.